Mr. Buti, one of the things we've seen in Europe in recent years is a divergence of growth rates, particularly with Germany seeming to do much better than its neighbours perhaps. One of the things that the IMF report talks about is a convergence but to a new slower rate of growth for the region as a whole. PIMCO has talked about the new normal, meaning we should expect lower growth rates going forward. Is this what we should be expecting to see in the euro area?
Well, I mean, since the beginning of the crisis, I would dare to say, even before the famous Rogoff-Reinhard book on the aftermath in terms of growth of financial crisis, we have indicated that it is likely that the heritage of the crisis will be a lower growth rate. Obviously, if policies respond properly, then can be overcome. But the crisis has an impact not only on actual growth rates, but on output, on potential output, and this is true throughout the advanced world. So true also for the euro area. We had some divergence of growth. Germany performing well. Now there is a soft patch, actually softer than we expected, and there is a certain new convergence. So it is possible. Obviously, all this is not policy independent. It will depend very much on what we do in response to the crisis.
And given the global backdrop where for years we've had the emerging markets, but particularly the BRICS, making up some of that shortfall maybe for us, that seems to be fading a bit, and also that the US doesn't seem to be coming into a recovery as strongly as people had maybe expected. Seems to be unfortunate timing for Europe to be compressing its growth rate, given that that global backdrop is gloomier than it has been.
No, yes, I mean, the idea that there is within Europe and worldwide continuous divergence and dichotomy of performance is an illusion. I mean, we can have it on a temporary basis, but then I think reconjunction, I think, is the name of the game. We have a challenge for the whole global economy, and growth, I think, is the key issue, and it interacts clearly in a potentially perverse way with sovereign debt crisis in Europe, with financial market tensions, with a fiscal outlook in the US. So, I mean, we have formidable policy challenges in front of us.
Now, the positive spin, I guess, of the slowing growth is that it means inflation is maybe less of a concern than it has been. We're seeing central banks all around the world maybe rethinking the outlook for monetary policy. The European Central Bank meeting. What do you see the outlook to be for the European Central Bank on interest rates? They are fiercely independent. They're going to have a change of leadership. Would you think that maybe the 2 interest rate increases we've seen already will need to be unwound as a way of supporting the growth agenda going forward, given that the inflation outlook appears to have changed? Okay,
well, you would not be surprised. I never comment on monetary policy, the choices of the European Central Bank, and I don't comment on exchange rates. This is the, let's say, the name of the game. At the same time, I think it is true that the prospects for lower growth worldwide implies also less tensions on and less pressures on inflation. Some elements which had put an upward pressure in the past year, arising from the Arab Spring, the impact on the oil price, are fading. They have gone away. So I think there is prospects for price stability is there, and I think will help the job of the central banks in sustaining growth. One of the advantages of EMU, now we tend to be a bit pessimistic on the euro area, is that the central bank, the ECB, has managed to guarantee price stability literally according to their mandate throughout the past 10 to 12 years, just below 2%, their definition of price stability. And if one looks at inflation expectations, they are very well anchored. So yes, we have difficulties, but it is not a crisis of the euro, it's not a crisis of the monetary architecture that we have. It is problems that we have with a number of member states and with the governance rules of EMU. But overall, the ECB is delivering, and delivering very well.
Speaking of the architecture of monetary union. One of the key components of a well-functioning financial system is, of course, the banking sector. What we're seeing in the market at the moment is a lot of investor concern about the need for a recapitalisation of the banks, but seemingly an unwillingness on the part of the private sector to be the provider of those funds. How do you think Europe will need to progress on this issue? Do we need to see more consolidation, more cross-border mergers, for example? Will governments need to put some more money into the banking sector to ensure that stability? How can they give investors the confidence to actually provide the capital that the banks need to bolster their balance sheets, particularly as the regulatory regime gets a little bit more fierce for them?
I mean, what we see clearly is a potential perverse interaction between the situation of banks and the sovereign crisis. So we have to break that link. We have performed in the spring and summer a new round of stress tests conducted by the European Banking Authority, which is a new authority within the new global European architecture for supervision. There has been quite a lot of recapitalization, about 50 billion in advance of the stress tests. But clearly now the markets are concerned about the interplay between the bank's balance sheets and the sovereign. So it is absolutely key that we tackle in earnest the crisis of sovereign debt. That will reassure the market a lot. And in such, say, higher risk aversion environment, banks also have to make an effort. I would not talk about, I don't like the definition of recapitalization. There is not really a capital shortage at the moment in the European banking system. I think what is important is to create sufficient capital buffers to absorb possible negative shocks. This is the work that we are doing at the moment.
And one of the issues that we keep hearing from investors in the linkage between the banks and the sovereigns is the unwillingness of some of the banks to maybe write down their debt holdings to reflect current market levels, to take the haircuts that the market is suggesting that those bonds really should be having. Do you think there's enough transparency in the banking sector about A, what they have on their books, and B, what those assets are truly worth, given this mismatch between market pricing and some of those accounting levels that they've maintained?
I mean, we have been reluctant in providing a signal that mark-to-market evaluation should be implemented across the board, regardless of the situation of the different countries. I think what is important is that we do not give a signal that sovereign debt is about to be, written down across the board. There will be a, defaults, cascade of default. This is not clearly not the case. The situation differs in different countries. Some supervisors have imposed mark-to-market, and the banks have done it. In other cases, they have not. Done it. I think we need, more transparency on this. The work is ongoing on this point to make the bank stronger. So I think financial repair is indeed one of the issues still ongoing. More progress needs to be made on this point. And for the supervisor for member states, what we need in this is to provide the proper backstops. There is a commitment to do that by mid-October. We have established at the European level, at the euro area level, the EFSF, which is the backstop to tackle a sovereign crisis, which in its new version could also help recapitalize banks via loans to member states. I think the first priority is to try to raise capital through the private investors, so through the markets. But if this is not possible, then we have also other tools at our disposal. It is important, I think, to have a coordinated strategy which would overcome also stigma effects. So this is currently under discussion.
And if the ESFF mandate expands in that way and it becomes part of the toolbox for ensuring the stability of the financial sector. Are you confident it can hold its AAA rating, given that expansion of its abilities and perhaps some leveraging of its funds to enable it to meet those new tasks? Can it maintain a AAA rating given that progress?
We are working on the EFSF now. First of all, there is an ongoing process at the national level by all parliaments and national authorities to adopt the new EFSF. So this is ongoing. I think it's proceeding very well. It was very important that the Bundestag on the 26th of September adopted that. So there's still now a couple of member states still left before the final adoption. I'm confident that by the meeting of the European Council in mid-October, all the ratification will be done. And we are working at the same time in establishing guidelines for the operation of the EFSF, for the new scope of activities. Intervention in banks' capital, so recapitalization via loans to government is one of the activities. The other possibility is to intervene in primary markets, in secondary markets. The guidelines are going to be drawn up in a prudent way to ensure that the AAA will be maintained.
And so that's going to be a sacrosanct feature of the FSF going forward?
I think we are definitely aiming at this.
Okay. One of the things about the private sector involvement in the July package was the idea of a 21% haircut. Now, there's been some talk this week from governments that maybe the world has moved on and there needs to be a rethinking of how the private sector is involved in aid, is involved in maybe giving up some of its capital to reduce the debt burden on those countries that are struggling to meet their debts. What is your view on that? It seems that the package was in place and was agreed to, and now the goalposts are moving a bit, and that maybe investors are a little uncomfortable with what may come next on that issue.
I mean, what we have seen since the 21st of July, when the decision was made, there has been evolution in the market, which are quite significant. I mean, in particular, what we have seen is that interest rate on the Bund and the swaps rate have come down. Also, the calculations at the time were made on various options and the balance of options in a way that was assumed to be 25% for each of the four options. Now it is possible that there will be one option privileged compared to others. The reduction in the interest rates implies that the upfront cost in terms of collateral for member states, for creditors, would be higher. So I believe that these essentially technical issues would be looked at, and there will be a discussion, I think, with investors. I mean, the offer is out there, and there will be some, I think, some discussion on this. Discussion are ongoing, and but it is not to change the spirit of the 21st of July, is to take into account the market evolution in the meantime. And
do you think you can still hit that high participation rate that was mentioned if the haircuts get bigger?
I've not said the haircut is going to be bigger. What we have seen is that the deal since July, since the lower interest rates that have taken place in the past weeks, has become somewhat more generous for the private investors. So this is the situation arising from market developments. I am confident that the participation rate will be high. I think we can see quite a lot of interest in this, so I'm optimistic.
Okay. One of the things that the IMF report talks about as well is that going forward, for confidence to remain in the euro and in the monetary union project as a whole, there will need to be some evolution on a fiscal level. And it may be suggesting that some small ceding of fiscal sovereignty to a central body will be an essential part of restoring investor confidence and getting the private sector back involved in lending both to the banks and to the governments in the euro region. How might that evolve, do you think?
I mean, We have many open areas in which if one takes a little bit of distance and looks not with our nose in the plate as we do it every day because of market pressure, but take a bit of a medium-term perspective, we have achieved in the past 12 months enormous advances in Europe. I mentioned before the European Banking Authority. Now we have a new system of supervision. The European Parliament and the Council, following the proposal of the Commission, has established a new system of governance, the so-called six-pack, where we strengthen the Stability Pact, we establish a new process of surveillance on external imbalances, which was completely lacking throughout the first 10 years of EMU. So there will be stronger surveillance on the fiscal side and a system of more automatic incentives and sanctions. This is going to bring about a sea change in terms of surveillance and the capacity to spot divergences. There is going to be more accent on public debt rather than simply the deficit. As part of this process, I think there is a stronger responsibility for the central body, for the European Commission, the independent watchdog in the implementation of fiscal surveillance. Do we need to go beyond this? It is possible. I would say it is even likely. We have to build on what has been adopted recently, implement it seriously, and go beyond if needed.
So evolution rather than revolution would be the message.
I mean, we are revolutionizing things already, so it will be an accent with the path of revolution.
If we look at where the bond market is now, one of the proudest achievements of monetary union, and Mr. Jean-Claude Trichet has been very vocal about this in the past, was that rates converged in the bond market to the German level, to the best level, the cheapest level that was available in the region. What we've seen recently is a divergence, and one of the things that the IMF says in its regional report is that maybe those days will not come back. Maybe now investors recognize there is always a differing degree of credit risk for different countries, even within the single currency zone, and that we will have differentiated borrowing costs for all of the Euro members going forward. Would you agree that that is the most likely outcome, that we will see those differentiated borrowings and costs persist?
I mean, the convergence to the German Bund of the interest rates of all the countries, even with dramatically different situations, a dramatic different level of debt, competitiveness, etc., was a mixed blessing. I mean, we realize now ex post that it was part of the general move of the so-called Great Moderation, which characterized the decade before the crisis. And in Europe, in the euro area, there was an added element due to the disappearance of the exchange rate risk. But it was a mixed blessing. It gave the impression that potentially vulnerable countries could relax and not do what was fully needed in order to put the public finances under control, reduce the stock of debt, boost competitiveness and growth. So yes, this compression was not a healthy one. At the same time, what we see now, this opening of differential, is not healthy either. I think it is not normal that we have such a huge increase in the spreads. I think markets are not assessing properly the inherent credit risk of different countries. We are working to address this. I don't want to be complacent at all and say that is the market fault. Obviously, a lot is going on. A lot is being done at the European level, at the euro level, and at the level of individual member states. So what I would see in the future is, yes, we are not going to go back to a full compression of interest rates, especially on the long maturities. Obviously, at the short maturity, they will remain very, very convergent. So we'll see some spreads in the future, but much lower than we have now. So I think that will be a healthier move, and looking forward, it will help also to have market disciplining the governance.